Hey guys, welcome back to Everyday Finance. My name is Callan, and on this channel we bring you 2 videos every week on topics of financial independence, investing, saving, and budgeting. So today we're going to be going over the 5 stages of financial independence, and I'm going to cover some of the unique characteristics of each stage. And I'm going to give you motivating tips and tricks on how to progress throughout each stage. The first stage of the 5 stages is survival. In the survival stage, one key characteristic is that you have your expenses can often be more than your income. So you're living above your means. And what this is doing is it's creating negative cash flow. And by having negative cash flow, you're really living in this paycheck to paycheck grind, and you're just not able to get out of it. This stage is often one of the most stressful to be in because it just feels like you can never get ahead, never make progress. And I'm here to give you a couple of tips and tricks that'll help you get out of survival and progress to the next stage. Now, in survival mode, you are just trying to make ends meet. If you're in the survival mode, it's important to understand how you got here. Whether you are a new high school or college grad, it's understandable you're in this phase. Maybe you've just got your first job. It's important to pick it up quickly and start making good financial decisions. But if that doesn't describe you, how did you get here? You may have made poor financial decisions, or maybe you have a lack of intentional financial planning. That's also very common. So if you understand how did I get here, it's really important to know what you need to change in your life to make sure you don't end back up in this state. The best ways to get out of that is to really sit down, analyze your expenses, create a monthly budget, track your expenses. I would recommend tracking for 3 months just to get a feel of your average expenses. They go up, they go down, you'll get a good average. And by doing so, you really lock in what you're spending. And if you're looking to make cuts to your expenses, look at the 3 big areas first. That include your housing, transportation, and food. Now, the reason I say these 3 areas first is because for most people, these areas comprise nearly 40% of your monthly budget. So if you're able to make cuts to these areas, you will see significant progress in reducing your expenses. You can cut cable, you can reduce your cell phone bill, you can look at things like monthly subscriptions, be as aggressive as you can be and cut those monthly expenses. While we're talking about cutting expenses, I want to mention this concept of creating gap in your financial life. By gap, I mean the difference between your income and expenses. Now, after you've made all the cuts to your expenses that you can make, you want to look at ways to increase your income and thus create that gap and get more positive cash flow in your life. Ways that you can increase your income, I'd recommend picking up part-time, second jobs, side hustles, anything that you can do. It's really important that you be aggressive and really hustle in this stage of your financial life to dig yourself out, make some financial progress. The second stage of financial independence is financial stability. When you've reached financial stability, you're no longer living paycheck to paycheck. You've created a little space in your life. It's going to feel really good and comfortable if this is the first time you've made it here. One common characteristic of financial stability is that you've built up a little bit of savings. Now, by a little bit of savings, I mean somewhere between the $1,000 to $5,000. You've done this by increasing your gap or positive cash flow. Now, we're not talking a full-blown 3 to 6 month type emergency fund. We're just talking a little starter one, $1,000 to $5,000, just enough to cover if unexpected emergencies come up. You won't have to go out and charge it on a high interest credit card, schedule monthly payments through anything like that. You're gonna have enough savings to pay for that. Another thing with being in financial stability is that you have positive cash flow now in your life. So you have the room to be making additional debt payments to reduce your debt and save while at the same time. So you're going to notice that your net worth is increasing. And so what I mean is that your assets are growing and your liabilities are decreasing. By assets, I mean your checking accounts, savings accounts, investments are increasing, and you're paying off debts like your car payments, your student loans, or high interest credit cards. Anything over a 5% interest rate, you really want to prioritize paying that off. Whereas if you have a low interest debt, you may just continue making payments on that and pay it off over time. Another thing to consider is the debt associated with an income producing asset. Sometimes taking out debt to buy an asset, especially if an asset's going to return you income or capital appreciation, is a good thing. Consider like a rental property. If you buy a rental house purely for an investment, if you rent that out every month to a tenant, you're going to be making money on this investment. You're paying off the mortgage, you are earning cash flow from that. You're also earning potential capital appreciation. So you're really making money on your money. Other than the risk associated with carrying a mortgage, you are really making your money work for you. And this is an example of a good way to utilize debt to build wealth. Another characteristic of financial stability is that once you've arrived in this stage, you are not easily knocked out or pushed back into survival mode. You have some emergency savings and you have learned to control your expenses and you're increasing your income. And so if an emergency comes up, you're not going to be frantically worrying about it so much, and you're certainly not going to revert back to your old habits of being in survival. And this is a fantastic place to be. The third stage of financial independence is debt freedom. Debt freedom is where you have paid off all or all of your high interest debts and you are significantly able to increase your net worth. And so again, on the topic of debt, not all debt is bad, but at this stage you've certainly paid off your credit cards, you've paid off your car loan, you've paid off your student loans. You may or may not still have a mortgage on your primary residence. It really depends on your personal opinion whether or not you view that as a bad or as an acceptable debt. You have aggressively paid off a lot of debt and you are able to invest heavily in building financial assets that will serve you and grow your wealth over time. So in this stage, you will see the largest increase in your net worth over time. You should be able to have a pretty aggressive savings rate, somewhere in the ballpark of 20 to 50% would be very good. This would be your ability to take 20 to 50% of your income every month and invest it into an asset in some shape or form that will be able to grow your money as opposed to just paying off debt or spending it. Now, in regards to the financial independence retire early community, a lot of proponents of that will recommend a 50% savings rate or even higher in some cases. I myself would say if you can hit a 50% savings rate, you are doing extremely well and you are going to see a lot of financial progress very, very quickly. The fourth stage of financial independence is financial security. In financial security, you have enough invested assets that you can pay for most of your living expenses. Consider these your necessary living expenses. Think of housing, food, transportation, utilities, things of that nature. While you may not have enough to cover all of your lifestyle choices, you have reached a stage of financial independence that very few people reach. And so you should feel very good at this stage. And I would recommend if you're like a lot of people in the FIRE community and you've reached this stage fairly quickly, I would recommend take a moment and consider things that you can do now in your life that you've been putting off. For example, if you're in a house and you want to remodel a kitchen or put in a pool, well, at this stage, you have a fairly large net worth. You're plowing a lot of money into savings, probably 50% or more of your income into savings. your net worth is growing very quickly, you can afford to do these kind of things now. For example, your investments are returning more income into themselves by reinvesting than you're probably able to put in there through your earned income. So I would consider this kind of the turning point in your journey to where you can reroute some of your savings that you would have put into your investments, put those into some things that bring you joy in life. For me, I think my family, we are looking at putting in a pool in our backyard. And this is one of the things that we've talked about is when we reach this stage, we're gonna reward ourselves with a nice pool in the backyard. It's also very important in this stage of your journey that you recognize that with a great portfolio that you've built, you have a lot of financial responsibility. So you want to take your financial decisions very seriously and educate yourself on all things financial. You want to think about tax optimization, financial planning, estate planning. All of these things are areas that you need to be thinking about, and especially if you are doing investing on your own, you want to be highly educated and really into the research. So whether you're investing in index funds or rental real estate, or particularly individual stocks. If you're investing in individual stocks, when you have a large sum of money like this and you are taking great financial risk investing in individual stocks, you want to be very educated and research and have that assurance that you are making good financial decisions. And if you make poor financial decisions, you are going to see significant consequences because of your larger portfolio size. The fifth and last stage of financial independence is financial independence. And this stage, you have a large enough invested asset portfolio that will pay for all of your living expenses. So this includes your necessary expenses and your lifestyle choices. A common rule of thumb is you take your invested assets and you take a 4% of that, and that is the amount of money you can spend per year. So if you've hit that number based on your particular and specific spending, then you've reached financial independence. And congratulations, you have worked diligently and you have made it. This doesn't mean you have to retire early. Certainly could mean you could do that, or you could just do something else. Do something else that brings you joy, whether it be volunteering or starting a new business or taking a leave of absence from work. This really gives you a lot of flexibility and control in your life that you may or may not have had before. Financial independence is all about having choices, and you've worked hard and you've made it, so now you have the right to make those choices. There certainly is no magic number for what means you've hit financial independence. It really is a personal number, so everyone is different, and you really have to know your own specific needs and wants in life. So along the journey through all 5 stages, you need to be analyzing your spending tendencies and really changing as you go. Maybe you spend more in certain times of your life, spend less in other times of your life, but your FI number can change over time. Your financial independence number, that is. One person's FI number is going to be different than another person's, and that's okay. Don't confuse your financial independence number with your net worth, because they are not the same necessarily. So your net worth is your assets minus your liabilities. That is the amount of net worth or net equity that you have. Financial independence number is really based on a return of a specific portfolio size. So if you have $1 million portfolio and you estimate that you can withdraw 4% of that annually safely, then you could withdraw $40,000 a year and have reasonable assurance that you would not run out of money. Whereas your net worth is going to have assets in your portfolio that may or may not return you any income or have value added for income's sake. So don't confuse the two. They are somewhat related but different. Now, I hope this information has helped you and that it motivates you to continue on your journey to financial independence. If you've enjoyed it, please go ahead and smash that like button. Don't forget to subscribe to the channel so you never miss a new episode that we launch. We'll see you in the next video.